Welcome to TheoTrade. This is Don Kaufman. Here we are. It's February 16th, 2018. All right, where to begin? This past week, we see a rip and rally. After the previous week, what we had was some, well, epic volatility. But a few things that we want to talk about in regards to this rip and rally. First of all, I received a ton of emails specifically today. So here we are on Friday, we're coming into a 3-day weekend, and a lot of the emails kind of went along the lines of this. Hey, it's a rip and rally. I kind of feel like, we should have been bullish throughout this. And the irony was some of the comparisons in the email where this is one of the biggest rallies since 2011. Now, do me the favor, and we'll look at the charts here in a few minutes, but if you look back into 2011, the rally that this was being compared to was also right before some of the most tumultuous volatility that the markets had seen since ultimately 2008 and 2009. So if you are looking at this as being one of the best rip and rallies and you kind of feel like you missed some of the upside, well, ultimately, again, look back at that chart to 2011, because again, that rally was in the midst of some wild volatility. Now, there's no comparison necessarily to this in 2008 or 2009. Nevertheless, you have to recognize that in the midst of some of the most wild rallies that we've ever seen, people, that is the hallmark of volatility, and that's precisely what we pointed out on last week's video and throughout the course of this week, that these rallies, okay, are part of the volatility kind of structure. Now, the next thing what we're really going to talk about is specifically volatility futures and volatility futures, what they look like right now. Now, again, I'm going to point this out in some of the charts here momentarily. But for the most part, to give you a quick explanation, the volatility futures themselves are still inverted. And what that means is in the shorter term, volatility is actually higher than it is in the longer term. So if you think about it and just put it in context, all right, 1 month volatility is greater than, let's say, 100-day volatility. So you have 30-day volatility and you have 100-day volatility. And what the market's saying right now is that risk is actually going to be greater in the next 30 days. So there's a better chance that the world blows up in the next 30 days than it does in the next 100 days. Clearly, that's a sign still, okay, of volatility ultimately to come. Or, if you will, the marketplace is still pricing in, okay, quite a bit of volatility. Now, some of you might not be that comfortable, per se, looking at volatility futures. Instead, all right, we can go to the VIX. Now, the VIX is kind of my predecessor's way of looking at like volatility, but if you look at the VIX is just not backing off very much. We're still just shy of the 20 level. Another thing to point out about the VIX was Thursday's trade this week. And there's an interesting irony again with Thursday's trade. The S&Ps exploded to the upside by 33 points, and yet the VIX, it didn't contract. It contracted a little earlier in the week, but the VIX didn't contract on Thursday in one of the most wild up moves that we saw. Furthermore, the markets on Friday, ultimately today, as the markets were exploding a little bit higher, the VIX not only didn't contract, the VIX actually started to go back up, and then the markets actually reversed. Okay, late in the day on Friday, we ended up the day massively unchanged. All right, so we talked a little bit about the structure of the volatility futures. We looked a little bit at the VIX. We talked about rallies being normal in the midst of volatility, but let's also bring up the idea, well, of bonds and more importantly and more appropriately, interest rates. So the interest rates, specifically we'll look at TNX here momentarily, the interest rates are still sitting right around 2.8, 2.9% on the 10-year. So what really sparked this issue, okay, over a week ago now, and what sparked the volatility was the rise of interest rates. So the market now, okay, is accepting the fact that rates are going to be higher. Accepting it, okay, and ultimately being able to trade through it are two very, very different things. So we've accepted, okay, we're going to have higher interest rates. That is going to take a toll on the markets. From everything from stock buybacks, granted, there's a lot of repatriated cash that's in the marketplace going to be used for stock buybacks, but if you look at the market as a forward-looking mechanism, you better believe, okay, that traders and investors are going to look forward and be like, wow, when those rates do start to climb over there, that's going to put a hurt in the entire market. I mean, this is everything from consumers, all right, to if you look at junk bond debt out there, stuff is going to start to go skyrocketing. And we all are aware that the debt loads now are massive. Last but not least, and again, before we get to the charts over here, there's just one thing like I've kept in mind all throughout the course of this week. We have seen, again, an explosive rally over a number of years. We hit one patch of volatility. However, this week we rally right back out of it. And I can't help but in the back of my mind think to myself, I'm like, they're just trying to bait us a little bit more. Come on, it's okay. It's okay to invest now, right? It's safe, come back into the water over here. And I just cannot get that out of my mind. You know, volatility's not backing down. We've seen rip and rallies like this before. And again, don't get baited right now into the short term. You know, whatever your risk happens to be, you better be intimately comfortable with that risk moving forward. With that, let's go ahead and get to some of the charts here and go through some of the specifics involving some of this past week's trade.
All right, so let's get started here looking specifically at the volatility futures. Now, as I was mentioning, the volatility futures are still inverted. Now, before I get into any specific detail, what you need to know, like what does that amount to? So the volatility futures are inverted. It sounds very interesting. What it really kind of breaks down to when the vol futures are inverted, it really means like helmet on, you know, get under your desk, rock back and forth because we're still going to be in some volatility. And really, I'm going to kind of map this out for you right now. What you look at when it comes to vol futures, you look at the here and now, right? So here's 33 days and it's trading right at around 1780. Then you go a little further out, like 61 days. Okay, it's trading for, you know, it's down to 1730. So we have 1780, 1730, you know, you can even go 124 days out and it drops off a little bit. And the way to kind of position this, like, again, what it means in context is this 1780, okay? That's the here and now. That's for the next 33 days. But then you go further out in time and volatility actually drops off a little bit to like 1736. Now, what I'm actually creating over here is what they call a depth chart. And this goes out to 61 days. But again, to kind of put this in context, I'm drawing my own chart over here. But to put it in context, it means right now, right here, in the next 33 days, we're going to see more risk than 61 days from now, which is totally crazy when you think about it, because like there's a better chance, okay, of the world falling apart in the next 33 days than there is in the next 61 days. And again, than there is in the next, 124 days. Now, there are ways to kind of plot depth charts. And here is a depth chart. The first curve down below over here, this happens to be what it looked like precisely a month ago. So I built two different curves in here. And you can see the difference. And again, what these curves mean, this was exactly a month ago, and that means right now has less risk than in the future, okay? Whereas today's depth curve, there's more risk right now than there is way out in the future, which again is just crazy stuff to ultimately think about. Now, if that doesn't necessarily do it for you, you're like, okay, volatility depth chart, I like it. It sounds pretty good, okay? If that doesn't necessarily do it for you, just go look at the VIX. All right, so let's look at the VIX. And the point that I want to make specifically with the VIX, and I'll zoom as tight as I possibly can in over here, is even like, you know, yesterday, and yesterday was Thursday, you can see the VIX totally flatlined and even picks back up. So we're trading just shy of the 20 region. But what's interesting about that is, you know, typically speaking, if you do take a look at the VIX, and you kind of compare it to the S&P chart, look at yesterday's trade. And again, I know I've got a lot of expected moves and so forth on here, but look at yesterday's trade. Here was Thursday's trade. And this is a fairly big up day. So you're getting an up day. What did volatility do? Boot, totally flat. Volatility didn't move down when the marketplace was exploding to the upside, which, you know what? That brings us right to the S&P. So let's just get right to it. Let's not hedge around it at all. I talk very often about a marketplace that has efficiency and inefficiency. And what that really amounts to me, and again, if you haven't tuned in to a lot of the weekend videos or any of the videos, you're probably like, I have no clue what efficient or inefficient means. It has everything to do, okay, with expected move. And what these lines are drawn out here, and again, let's go over a little bit. First of all, okay, these lines happen to be the expected move each week. That's the move that is kind of predicated based on the options premium. I'll give you a quick example. A quick example of that happens to be this next week. Now, this next week, in all fairness, only has 4 trading days. Why? There's a holiday on Monday, so there's only 4 trading days. And in 4 trading days, that's 4 days, what's the expected move going to be? And the expected move is about $53, I think, and 71 cents. It's plus or minus. Now, that is what's represented on these lines. So this is where we start. Okay, this is the upper end of the expected move, the lower end of the expected move, and it's about $53.71. And if you're kind of like, where'd that $53 come from? What am I, pulling that out of thin air? I'm not pulling it out of thin air. I'm just simply going over to the options chain itself and deriving it specifically from the expected move. Kind of what it is the at-the-money options and all the options in the chain averaged together. But we're sitting on, right now, about a $53 expected move. And to me, that's pretty hefty given the fact that we have, again, a limited trading week. Now, the previous week, right? That's the week that we just ended. That's literally ending today. Okay, the previous week, ooh, that was a big expected move. It's one of the biggest expected moves we've seen in recent history. How big was it? Well, you know what? You have the ability to go back and to take a look specifically at expected moves from week to week. And in essence, to do that, okay, we could just go back in time. So here we have ultimately what? Today? We'll go back exactly 1 week. All right, we'll go back to the 10th of February. We'll look out a full 6 days and you'll see that was a $94 expected move. Now, when I talk about efficiency and inefficiency, what this basically means is for a huge period of time, going back for over 3 years, for almost 3 years, almost all of the moves that we saw, okay, were inside what was expected. There's some glimpses here, just a few glimpses where we moved outside of what was expected. Now, compare that to the present. The present, what are we seeing in the present? There's a breach. There's a huge breach, a monstrous breach. We cracked it to the downside. This week we cracked it to the upside. Okay. In all of the recent weeks, we've only had 1 week now since the beginning of the year. It's right here where we have not breached the expected move. What that screams, okay, still, now we have the volatility futures that are screaming, well, the volatility is not over. And you have the expected moves in the SPX screaming that volatility is not over. What else do you need? Wait, there's more. Okay, there's more on that front. Go look at the VVIX. It's the volatility of the volatility index. It's still raging at 120. I mean, again, so you have the volatility futures showing risk. You have the VIX still showing risk. Okay, you have the expected move in the SPX that's still being breached, showing signs of inefficiency in a wild market condition. You have interest rates that are up there. Okay, my personal favorite is a lot of people comparing this rally. And again, if you bear with me here for just a moment, we'll come over to the S&P futures, and I'm actually going to snap this to a 30-day 1 hour. Okay, you have a lot of people comparing this to rallies that were happening back in 2011. Wait, I'll go back into 2011 here momentarily. But if you look, there's a double bottom. It's stable. We rallied back up 70% of it. Okay, but this is very prototypical of a highly volatile market. People, I'm not telling you this necessarily to be bearish on the marketplace. Okay, we're simply going over, okay, all of the factors that lead us to believe that markets are still in what we would term the extreme. And again, to me, there's this constant feeling, and I talked about it, a moment ago, there's this constant feeling like you're just getting baited right back into it. And you have to keep in mind, even with, this week's rally, go look at the TNX. If nothing helps you, look at the TNX. This is a rising interest rate environment. And you may believe that the marketplace has accepted rising interest rates. But again, those rising rates, no matter what you might think, they're going to take their toll. I mean, one of the things that really shocked me this week, and I'm actually going to show this momentarily, but what shocked me this week is, listen, interest rates were still ripping to the upside throughout the course of the week. And yet, if you look at products like XHB, what is XHB? It's the home builders. Okay. The home builders are like, nah, it's okay. We can rally. So the home builders just rallied right back up with the rest of the marketplace. Yet the interest rates were rising. Now think about that for a second, because higher rates typically what? Kind of contract some of the home builders over there. People get a little bit nervous. But again, right now, you kind of feel like the market, it stared down death in the face and it laughed. The only problem is, okay, yeah, volatility is going to win that war out there. So moving forward, we still believe that there is a tremendous amount of volatility ultimately packed into this market. Moreover, looking forward, a $53 expected move this next week in the S&Ps with only 4 trading sessions is still evident, okay, of some extreme volatility. You know, I'm not going to cover a tremendous amount of the individual stocks this week, because what I want you to focus on just moving forward, what your risk happens to be. Okay. If you bailed out of a portfolio in the midst of this down move only to see the markets bounce back up, fantastic. Okay. It's okay. Each and every week when you're in the midst of this volatility, you have to make that decision. Is the risk right for me? You're going to have to be able to sustain these wild moves, right? If you can't sleep at night, you know your risk is too high. And that's the single most important thing. The opportunities that are going to be presented to us moving forward, right? Let me just clear off all these expected moves, because, you know, in summation of this kind of week's action in the marketplace, you have to, again, be mindful of what all of this really amounts to. And that is the opportunity that's going to be presenting itself time and again. If we are in the midst of more volatility, okay, you sell the premium in the down move, okay, and buy it back when they're ripping. Forget so much about directional bias. See, that's the aspect that's going to take most retail clientele a very long time to shift away from. Your directional bias. And again, do I have a chip on my shoulder being bearish? It's not about being bearish. It's about looking for volatility. It's about the fact that over the last 5 years, there hasn't been any volatility. So if there's one chip on my shoulder, it absolutely is. There hasn't been volatility for the last 5 years. And we appear, okay, more than any other point since back in 2011, that we're entering into some fairly good chaos in the markets. Again, when markets start to get volatile, you have to put your bias aside. And you're like, what does that mean? The strategies that are going to work, okay, are about what? Selling premium, covering the premium in the midst of the rip and rallies. Exactly what we did this week. Hallmark signs of volatility. Think about it over the 3-day weekend. Enjoy the 3-day weekend. Thanks, everybody, here for joining us at TheoTrade.